Bitcoin to gold. This has the drop in Bitcoin. We think was more, well, first of all, it was more severe than we expected. And I do believe it's because of the liquidity constraints and restraints that we have seen during the last couple of months. We always believed those would be short term and still believe they will be. And so if we are right, we believe that the Bitcoin to gold ratio will resume its uptrend, especially if what I said when talking about the gold to M2 chart is correct.
Imagine a single Fed decision on December 10th unlocking a tidal wave of money that floods big tech, AI, gold, and Bitcoin. That's Cathie Wood's bet. Cathie Wood says the stage is set, and if December 10th brings the Fed's anticipated rate cut, money that's been waiting on the sidelines will sprint into markets. ARK's playbook is simple. Liquidity relief plus lower rates equals massive reallocation into AI, robotics, multiomics, and risk assets like Bitcoin and select stocks. That surge, she argues, isn't speculative, it's structural. Productivity from AI plus advances in multiomics are quietly making the economy more efficient, creating a deflationary tailwind that could free capital for growth investments. ARK has been ramping into these themes and publicly signaled confidence in crypto and AI exposure. But it won't be smooth. Markets are split on timing and odds of a Fed cut, and skeptics warn of lingering macro risks. Still, if the catalyst hits, Cathie thinks flows could be dramatic, a replay of big rotation moments, only bigger. Let's get more of the insights from Cathie Wood.
The Fed has been railing against anything above 2% inflation, and yet other market indicators have caught the Fed's attention, namely the labor market, and so it is relenting somewhat, albeit haltingly. And one of the other charts I like to share, we did share in the last one, Julian Falcioni, who used to work at ARK, drew this chart. He is at one of our clients now. And it is striking that gold relative to M2, remember we're saying M2 is starting to flatten out here. Gold relative to M2 really is as high as it's ever been, except for the Great Depression, when the money supply was collapsing, negative. It's no longer that now. And back then, gold was revalued. Or I should say devalued. It was a devaluation of the dollar in terms of gold. And that's why the spike back then. Now we don't have the first condition anymore. Money growth has turned positive. But we do have the second condition in terms of the dollar losing value relative to gold. And I think one of the bets that investors in gold are making is that the liquidity that spewed out during the COVID crisis is still going to find its way into inflation. We don't think so if money supply is topping out and velocity is rolling over. Now, I would like to give you, now that everybody thinks gold has only one way to go, if you look at the last two spikes there, meaning the last two other than the Depression, so the one in 1980 and the one a minor one in 2011. In 1980, gold peaked at $850. I was very young in my career, and I remember the day. And over the next 4 to 5 years, roughly, it dropped 67%. Why was that? It was because Reaganomics was working, and investors decided to focus on the equity market and the bond market instead of hedging continuing to hedge against the inflation that had been debilitating during the 70s. Inflation came down and continued falling, and the dollar became very strong. The dollar became better than gold. It was appreciating as gold was going down. And so gold dropped about 67% to $284 in February of 85. So yes, the gold price can go down. And we think we are moving into more than a Reaganomics market. We think this is Reaganomics on steroids, based on, especially on the tax cuts and the deregulation. Those two are much more formidable right now than they were in the early 80s, with the exception of the individual tax rate back then did drop by quite a lot, by 25%, I think, but it was phased in, and that's not the way to go. One thing about this administration, it has learned its lessons from the mistakes of Reaganomics. Do not phase in a tax cut. They made it retroactive. That was very smart. In 2011, the gold price peaked in September at roughly 1900. And by December of 2015, again, roughly 4 years later, we talk about the 4-year cycle in Bitcoin. That's pretty interesting. Both of those were effectively 4 years. Gold dropped from 1900 to 1050. So that was a 45% drop. And we would not be surprised to see something like that happen during the next 4 to 5 years. So on the next chart, just want to give you a sense of or a picture of liquidity. So liquidity moving down, what we told you during the last In the Know was that the combination of the end of quantitative tightening, now that was only on December 1st, so it's hardly had any time to impact, but that is effectively adding liquidity to the system relative to what otherwise would have been the case, to the tune of $30 to $35 billion per month. So that is going to help turn this line up. And then the Treasury General account, we think, is going to go up. Now, the Treasury General account cash built to the tune of $350 billion during the government shutdown. It has not, even though the government shutdown has ended, it has not started to unwind that liquidity, but we believe that it will, and actually is in the process of doing so. So we think this line is going to turn around fairly dramatically. Now, just to reinforce what I said before, those betting on gold are looking at what happened to liquidity during COVID, and it doubled. It doubled. These are very big numbers. Doubled from 3.5 trillion to 7 trillion. And now we're back down to 5.5. There is a fear that doubling will reverberate in the form of inflation. We think in the next, as tariffs work through the system, that the surprise is going to be on the low side of expectations, and that those worried about inflation will have to think twice about how they're positioned in the marketplace. Here it depicts the yield curve. It's at the short end of the curve, the 2-year minus the 3-month Treasury bill yield. And you can see this is still inverted, still below zero. And you can see anytime that has happened in the past, certainly for any length of time, we've seen a recession follow. And It has been amazing that we have not been in recession, but as we have mentioned before, we've been in a rolling recession. As the Fed eases, and we do think the odds are 80–90% for a cut on December 10th, this should start moving above zero. And then the longer term yield curve, which I know I talk about all the time, I'm kind of obsessed with it, is I think telling a story. We've put a downtrend here, a trend line, since 2008, 2009. And we were surprised during COVID that the yield curve did not reach levels it had reached before when the Fed was fighting recession. It reached roughly half that level. And here we are. Could we be peaking now? Well, that would be very interesting if short rates came down. If short rates and long rates come down, but this yield curve does not steepen anymore, I think it will be telegraphing that there are deflationary undercurrents out there. And hopefully some of the bond strategists will start analyzing it from that point of view as well. Here again, market and price indicators, S&P to gold. Again, watching that 70s period where it was a waterfall. There are some people betting that inflation is going to be that problem again. We are not, but this is in a holding pattern, and we think it will test, and the next move will be up, test well, and the next move will be up. But we are monitoring it closely. Here is, we think, a leading indicator. You see this S&P price to oil price plummeted during the inflationary 70s. It's doing the opposite now. So this, we think, is a leading indicator to the S&P to gold ratio. And here you can see long-term interest rates over the last number of decades. The peak, the double-digit peak in 1981, and the trough during COVID. And so the question about today's rates is, are we simply back into a period of normalization, just the market working and 5%, 4 to 5% being roughly the GDP growth rate, and interest rates following? I don't know. We will have to wait. My guess is we will see a leg down toward that 2.5–3% range, and that will be closer to the new range for the next few years.